Well, getting a move on, let's also take stock then of the entire earnings season and talk a little bit more about whether or not we are going to see earnings being impacted largely on account of this fears of the second wave, which are riding high, and the cases of coronavirus spiking. So what are going to be the implications on the overall earnings story? Let's find out. We've got Aditya Naren, who's joining in from Edelweiss Securities. Aditya, good to have you on board. Many thanks for taking time out. Let's get a sense first up as to how you're looking at the overall second wave of the coronavirus impacting Q4 earnings this time around. Do you think that it's likely to have a potential adverse impact for companies across the board? And if it's going to be specific sectors, which are those?
Hi, good morning. In terms of the second wave and Q4, I don't think it makes too much of a difference because Q4 in many senses is past. So I don't think it'll make a difference to Q4 earnings. I think what it potentially could start doing is making an impact on earnings looking forward, right? And that's where there is a fair amount of optimism that's built into the street. So I think that's where you might have a little bit of a challenge where, as the results start coming out, I think management commentaries might get a little softer than what you've seen in the last quarter. I think there are two things to look at. One is, of course, this is still very, very early in the year, right? So I think we have to be watchful of extrapolating too much too quickly. So I think that's one bit. I think the second bit is that in many senses, the manufacturing and the industrial side should not suffer too much because, the impact has been somewhat limited. But the services side is where you could actually tend to see much more weakness. So I think those are two things to look at. One, of course, it's not about Q4 earnings. Those are past. I think commentaries could get a little bit more guarded than they have been, right? And I think it's services that are going to be a little bit more vulnerable at this point in time than necessarily manufacturing.
Okay, fair enough. That's the view coming in. But what's the outlook that you are getting, or what is it that you're penciling across the board when it comes to the revenue trajectory as well as margins?
Okay, so I think there are two elements to this. In terms of margins, obviously there's a massive expansion on a Y-on-Y basis because at the end of the day, I think there was a shutdown base quarter that you're looking at. So I think there's a massive expansion there. But on a Q-on-Q basis, we are looking at the system seeing a drop of margins of about 180 to 190 basis points. So I think that is something that you need to keep in mind, that relative to the feel good that was created in the third quarter, the fourth quarter might be a little weaker because you clearly have some elements of cost coming through. Plus, you won't have the same pent up demand that came through in the last quarter. So I think that's one part. I think if you were to step back and see what the revenue side is, it is a little bit more modest. We are looking at revenue growth of about 5 to 6%, which is unlike what you're seeing from a profit growth, which will probably be about 100% plus on a Y-on-Y basis. And that is a reflection of two things that have continued to play out, right? One, that demand at the end of the day has come back in some manner, but it is not fully wholesome. And the second is that there have been massive gains on costs. And I think that is something that will tend to sustain through this quarter or show up reasonably well. But as I said, I think on a Q-on-Q basis, I think you need to be a little bit more watchful, even though they're not necessarily comparable because there is a high level of seasonality between the third quarter and the fourth quarter. I think one other thing that's important that you should keep in mind is that year-on-year numbers, as I said, there's a huge base effect, is not necessarily that relevant. I think if you look at numbers on a 2-year CAGR basis, I think that's where you see some of the extra health that is there in the system. So we are looking for the market at a 2-year CAGR of about 16% for this quarter. And I think that tells a much better story rather than the 100% plus that you'll see on a Y-on-Y basis for the 12-month period. But that's impacted by the shutdown that we had last time.
Sure. Aditya, even adjusting for the low base effect, the one problem that we've grappled with all through Q4 has been the sharp uptick in commodity prices. Which sectors do you think it's going to eat in more when it comes to the margins?
So, at the aggregates, it doesn't fully show because obviously the guys who are on the beneficiary side of commodities, of the commodity cycle, which is the commodity companies, they get a huge leg up. But the offshoot will really start showing through a little bit in the auto space and in the consumer staples space. So I think those are the two sectors where you will see a margin impact. As I said, you need to see them on a Q-on-Q basis, but I think that's where some of the pain actually lies.
You think largely the tilt would remain in favor of cyclicals? I mean, commodity players like we just talked about, banks, industrials, consumer discretionary, ex-auto, because they're going to see that marginal impact perhaps of a steel price hike?
Absolutely. The bulk of these very strong numbers that you're seeing, quite honestly, both for this quarter and looking out, are coming from the cyclical space. On the commodity side, it is simply commodity prices, and that's actually sustained into the current quarter, and it looks particularly robust. And we just actually overnight raised numbers there also. But the other is on the financial side, where they've taken a lot of pain in terms of the provisioning cycle that they had. It was obviously very exaggerated in the last quarter, in the corresponding quarter, but it has been an element of the banks for the last 3-4 years that you've had a high credit cycle. And I think that's what's going to sustainably reverse, over the next couple of quarters or a little longer. So that's where the bulk of the earnings is actually coming from. From our own portfolio perspective, I think that's where we are putting our overweights, which is really in the commodity space to some extent, which is industrials, in the banking space, and what we believe is a more structural story, which is the IT space, where you will also continue to get good numbers.
Aditya, what about where you see momentum softening? That's important to address as well. Talk to us about that and the kind of factors at play you see for pockets like an FMCG, a cement, even a domestic auto, for instance.
Yeah, so typically those are the sectors which have first taken a little bit of a cost hit, and so their margins are a little weaker. So we spoke in terms of staples seeing a bit of a drop off in margins on a Q-on-Q basis. The auto space is going to see a fairly consistent drop off in terms of the margin side. I think more important, this is an element that can very often be quantified. You can have a call on it, and it can tend to swing a little bit, and companies can do a little bit to address it. I think the bigger issue is whether the price hikes that are put in place by a lot of these players to limit the margin damage, whether that starts impacting demand. And clearly some of the sectors that you mentioned, the auto space, more so than the staple space, I think this is a space where there could be a little bit of pressure from a demand perspective. Not the least because you've actually also had the second wave come in, right? And it's a much deeper wave. It's spreading faster at this point in time. And, it can bring in a certain amount of hesitancy, both in people stepping out of their homes, but equally in terms of the demand momentum that they are effectively seeing. So, it's quite interesting. If you see the second waves that you've seen in the US and in Europe, it's actually been much more drainful or painful on the economies in Europe, where the lockdowns have had to be a little stronger and the fiscal stimulus has been less compared to the US. So I think, it's not just about commodity prices coming through and hurting some of these spaces. It's also the demand risk that they're running as a combination of higher prices and potentially, shutdowns.
Okay, thanks for joining us this morning, Aditya.